When a business disposes of an asset, it's not just a sale. It can be a trade, an exchange, an abandonment, or even losing the asset in a casualty or theft. The tax result depends on two things: what happened to the asset and what type of asset it is. On the EA exam, they love questions that mix the event with the reporting form. Start with classification. Your first reporting step is to decide whether the asset is a capital asset, a non-capital asset, or a Section 1231 asset. Most property used in a trade or business and held long enough is Section 1231. That classification drives whether you're looking at capital gain rules, ordinary gain rules, or the special Section 1231 netting approach. Here's the big reporting shortcut. Dispositions of business property generally start on Form 4797, Sales of Business Property. That includes many sales, exchanges, and involuntary conversions of business assets. Don't automatically dump everything onto Schedule C. Schedule C is for operating income and expenses. Asset disposition gains and losses often live on Form 4797 first, then flow to other places. Let's connect the events to what's taxable. A sale for cash can create gain or loss. An exchange can create gain or loss too, unless a non-recognition rule applies, like a Section 1031 exchange for qualifying real property. Abandonment is weird. You may get an ordinary loss if you truly give up the asset with no proceeds. Casualty or theft can create a loss, but insurance reimbursement can reduce or even create gain. Businesses and individuals also report differently. Individuals often think capital gain equals Schedule D, but business use property is frequently Section 1231, and the first stop is Form 4797. That's why exam questions love to sneak in a Section 1231 gain and see if you incorrectly include it in Schedule C net profit. Remember, operating profit is one bucket. Disposition results are another bucket. Bianca owns a dog grooming business as a sole proprietor. This year, she has gross receipts of $63,000. She pays $6,000 of wages, has $7,200 of supplies, and $1,500 of utilities. She also has a Section 1231 gain of $2,200 from selling grooming equipment, and she made a charitable contribution of $3,100. How much business income should she report on Schedule C? Think about it. The correct answer is $48,300. Schedule C net profit is gross receipts minus ordinary and necessary Schedule C expenses. $63,000 minus $6,000 minus $7,200 minus $1,500. Don't add the Section 1231 gain into Schedule C. That generally starts on Form 4797, and the charitable contribution is tempting to deduct, but it's not a Schedule C deduction for a sole proprietor. Which of the following is not Section 1245 property? Choices include livestock held for breeding, farming machinery, an office building, and computer equipment. Pick the one that does not fit Section 1245. Think about what kind of property 1245 covers. The correct answer is the office building. Section 1245 generally covers depreciable personal property like equipment, machinery, and certain livestock. An office building is real property, which is generally Section 1250 property instead. The tempting wrong choices are the equipment items, but those are classic 1245 examples.